Good morning. My name's James Gerrish. I'm the primary contributor here at Market Matters, and welcome to Direct from the Desk. I just wanted to run through a couple of things that we've been focusing on in the market this week. It's been a reasonably big week in terms of market news. We've obviously had the Federal Reserve increase US interest rates. I want to focus on that initially. Rio and BHP have been in focus this week, largely around capital management, driven by what we've seen coming out of Rio. I'll touch on that. A couple of the stocks that we've bought this week, we bought Aristocrat Leisure and the Emerging Markets ETF, and I'll also cover on some broader market themes that we're going to be focused on in the coming week. So just in terms of the US interest rates, I won't spend long on this, but the US did raise rates. The official benchmark interest rate over there is now, or target rate is at 2%. If you look at the implied futures rate going forward, so in December of 2018, so this December the rate's going to be at 2.25%, and then March in 2019 it's going to be 2.43%. This is dictated to by the futures market. The futures market's pretty accurate in terms of predicting interest rates going forward. So I guess the overarching thematic around what we're seeing in US interest rates is they're going higher. Global interest rates are going higher. The cost of capital is going higher. And I've written about it in a number of reports this week, just around that being one of our major investment theses going forward. So the impact or investing in a higher interest rate environment is going to be key for us going forward. I sit back and think about what is going to be can interest rates unravel the market from here? Is higher interest rates going to be a catalyst for some type of equity market sell-off? I'll just grab the ASX 200 on the screen. Just here to give you an idea of what the market's doing at the moment. So, interest rates going higher, if we're all expecting interest rates to go higher, then it's a known. It's not going to be the thing that unsettles investors and to see a large market decline play out. I think one of the things that could lead to a decline in the market, and we're conscious of these sorts of things, is around interest rates going higher than expected in a shorter amount of time. So right now, the US interest rates, the bond market is pricing higher rates. It's trading above 3% on US 10-year yields, but it's not pricing a sharp uptick in US interest rates. If you think about two things that could happen there in terms of US interest rates, inflation kicks up more than the market's currently anticipating. That will lead to sharply higher rates. We're starting to see some things bubble away in the background, so wages are starting to go up, etc. That is supportive of higher inflation. Higher inflation leads to higher interest rates. But I think more from risks outside the box. So if you think about the US-China trade war that's playing out at this stage, what could come of that to create sharply higher interest rates in the US in the near term? One of Trump's been the aggressor in this situation. China's been on the back foot. What if China goes and becomes the aggressor in this situation and uses some of the leverage they have over the US to bed down a better bargaining position as they enter negotiations? So, China is still the US's biggest creditor. They hold the biggest amount of US debt. They could step back out of the US debt market, and that would cause a sharply higher set of yields or interest rates over in the US. So, I think about those things. We're not seeing concern of that in the market at the moment, but I think it's clearly an area that we should be conscious of. But I think the main point that I want to stress here is that interest rates are going higher, global interest rates are going higher, so we need to be conscious of that when we're making our investment decisions moving forward. Rio's had a cracking week this week. This is a stock we've got in the portfolio. We bought into recent weakness, so we bought in the 72 area not that long ago. So we bought into this weakness. Fortunately, we've avoided this big decline in commodities that we've seen from around June onwards. So June to the early part of September, saw Rio come back around 15 odd dollars in terms of price terms. So it was a reasonably big route in terms of Rio stock price. So to give you an idea around what's happening around capital management, they obviously announced a big share buyback recently. So there's two components. There's an on-market buyback over in the UK. UK Rio stock trades at a discount to stock here in Australia, so that makes sense for them to go and buy stock on market overseas. Here they want to get rid of some of their franking credits off their balance sheet, so they're going to do an off-market buyback consisting of a small capital component, so $9.44 capital component, and the rest is a fully franked dividend. So the kicker here is around the tax benefits that you can generate from it if you're in a zero or low tax rate environment, or if you want to sell Rio stock that you've had for quite a while, because you're going to be taking, the capital component at 944 means that you can forego paying a reasonable amount of capital gain, or having a capital gains consequence on your holding there. This is yet to be determined by the ATO, so I'd stress that it needs to play out throughout October, but they're the broad numbers around Rio. So it can be about an 18% benefit to those in a zero tax environment if all your shares were taken up. Now the issue here is that because it's a good deal for some, it gets really well bid into the book. It's often oversubscribed, and you often only get a fraction taken of the shares that you tender into the off-market buyback. So in that respect, it's good in theory, but it's probably not as good in reality as perhaps the theory would suggest. In terms of our overarching views on Rio, we've got a 3% allocation. As I said, we bought it in around the 72 mark. If it comes back into the 77.50 mark, we'll be buyers again, and we'll be upweighting in terms of Rio Tinto. Moving on to BHP, because this will be an interesting one. We all know BHP has sold a lot of assets in recent times. So they've sold about $10.8 billion worth of US shale assets. They've said that those funds won't even touch the sides in terms of going back to Rio. They'll go straight through to shareholders. BHP will do a similar structure as what Rio has done, in my view. So there'll be an on-market buyback over in the UK. There'll be an off-market buyback in terms of Australia. In terms of timing on these, on the likely BHP buyback scenario, they have the Australian AGM on the 8th of November. Don't expect any news on the buyback announcement until the 8th of November, but they'll probably announce half of that on the 8th of November. So they're getting paid the 10.8 in two tranches, so they get about 5 billion in tranche one at the end of October, and then they get 1 billion in five 1 billion tranches each month thereafter out into February of next year. So I would expect a $5 billion capital management plan to be rolled out at the 8th of November AGM for BHP, and then not until February the other half of that capital management program should be announced. A couple of stocks we bought this week, which are interesting. Aristocrat Leisure. So a lot of people view this as simply a poker machine manufacturer. It's not anymore. You've got to view Aristocrat Leisure as a technology company. So the growth in this business comes from online gaming over and above the manufacturing of poker machines. So Aristocrat Leisure is very big in that area after they made a large acquisition at the back end of last year in that area of the market. So we've added Aristocrat around the $28, currently trading at $28.62. It is a US earner, so it benefits from the higher US currency. But if you're looking for, from a target perspective of where we're going to potentially exit out of Aristocrat Leisure, we want to come and see a test back up to this 32 to 33 high area in the not too distant future. So this is a growth stock. It's trading on around 23 times, so it's not overly expensive for a reasonable growth stock with US earnings as a potential tailwind. Now, the IEM, for those that don't know that is the Emerging Markets ETF. We added the Emerging Markets ETF recently, and this is a little bit outside the box, so I thought some explanation would be warranted in terms of the IEM. It tracks a number of emerging markets around the world, so the emerging markets have been hit on a number of fronts. They've been the loser in terms of the US-China trade war. So China has been a big loser in terms of market performance, and that's dragged down the emerging markets index as well. It's been a loser because of US dollar US dollar strength, so repatriation of funds back over into the US. It's been a loser because Trump has been pretty smart in trying to attract money back into the US through better taxation policy, etc. So, look, it's been a loser on a number of respects. I think our thesis around this is that the emerging markets have the rubber band has stretched too far to the south. It will correct and come back to be more in line with what the US market is doing. We've bought this below 59 Aussie dollars. We had a couple of questions just around the net asset value of this. Net asset value is always in US dollars. So if we're buying something and we're buying it in Aussie dollars, you've got to be conscious of the Aussie dollar or the currency translation in regards of that. So we've got the IEM in there. We've got a 3% weighting. We will up weight if it goes lower from here, but for now it is providing some reasonable strength. So I just wanted to cover off some of the main themes we're looking at the moment. Obviously today the Royal Commission, or the first draft findings from the Royal Commission, is due to be released, or it just has been released. We'll go through that in some fine detail over the next few days and come out with some views around that. I hope you enjoyed the presentation. I hope you have a great long weekend, and I'll be back to speak with you at some stage next week. Bye for now.